All right, well, I'm going to kick us off because I want to make sure that we have a good time not only to go through the conversation that we've prepared for you, but also give a lot of time for the specific questions that our audience members have. So I would like to welcome, let me stop my share here for just a few minutes so that you can see our panelists here. I'd like to welcome all of you for joining us. Again, if you've just joined us, please do take advantage of the chat session, noting panelists and all attendees. Just introduce yourself so that we know where you're coming from. We are delighted and thrilled by the reaction to this webinar. We have well over 100 people registered as of yesterday. So we know there's a lot of interest in this topic and interest in Aunnie's book, which was the inspiration for this event. Her book, Adventure Finance, was officially launched last week, but she has been putting her pandemic to very, very good use in writing it. And we congratulate her for that. And we'll be talking more about the specifics over the next hour. But essentially, this is for those of us who are trying to use capital more effectively to have an impact on the causes we care about. And I'm happy to have so many of you joining to think about that. So in just a moment, I will introduce you to the wonderful panelists we have who will be joining Aunnie in bringing to life these examples of innovative ways to deploy philanthropic capital. But before we get to that, we'd like to know a little bit more about you. So Heather, I would love if you could share the polls that we have. So we have just 4 questions here to let us know where you're coming from, what your perspective is, how involved you already are in using philanthropic capital for impact investing, and so that we can target our answers and our comments appropriately for our audience. And I always forget, as a host, I am seeing your answers come through. Are audience members seeing this at this point? No. All right, so Heather, let's give everybody maybe a minute or so to answer these 4 questions, and then we can share them with everyone. So I'm really pleased to see that we have a good representation in the category of which category best describes you? Just curious. That's always fun. And a nice distribution across various regions so far. All right, Heather, why don't we give it 10 more seconds and then we can share the results with everyone. All right, can everybody see these? So we do have quite a mix. We have philanthropists and investors, entrepreneurs, maybe not quite as many as in some of Aunnie's other launch events, academics and students. And as I said, I love that there's a good group of just curious. Look at that distribution across Africa, Asia, Europe, North America. Sorry that Oceania is not in the mix today, but South America is. It looks like you're joining us from the networks of the various different panelists. Again, pretty well mixed, but Aunnie has her own big following here, not a surprise. And then, wow, an exact 50-50 split on the question of whether you're currently making impact investments or receiving them from a foundation or DAF. And since we don't have many entrepreneurs with us, I'm going to assume that most of that is people who are making them. So we have expertise in the crowd, and so that's helpful for us to know when we get to the questions. Also, feel free to share your insights from your own experiences here. That would be very, very helpful. All right, I'm going to share my screen now and invite our panelists to go off video, except for when they are speaking. And then we will all come back on video when we come back to questions and answers. So again, I welcome all of you to Impact Investing for Philanthropists. If this is not the webinar you meant to be on, now would be the time to gracefully exit, but hopefully that will not happen. My name is Kate Cochran, and I am the CEO of Upaya Social Ventures. Upaya is a US-based nonprofit organization that makes early-stage investments in companies that create jobs for the extreme poor. We won't be talking a lot about Upaya's program model exactly, but it's helpful to understand that the work we do is fueled by investment capital, which is capital that we source from our supporters, and then we provide as investments to companies that we hope and expect will do well and will repay our investments so that we can then work with other companies. We're going to be hearing first today from Aunnie Patton Power. I mentioned that Aunnie's new book, Adventure Finance, is the inspiration for today's webinar. Now, all guests, by the way, will receive a discount code to purchase it. We'll follow up in an email after the webinar. I can personally vouch, as somebody who spent the weekend reading it again, actually, because I'd read an earlier draft, that if you think that a book written by a former investment banker, or recovering investment banker, as I like to think of it, who's also a member of the business school faculty at 3 different universities, including Oxford, London School of Economics, and the University of Cape Town, that this book might be a bit on the dry side. And I can assure you it is not. It is practical, it is full of interesting examples. It's a toolkit for funders and founders. So this event was meant to highlight the book by bringing some of those examples to life for you. And what you'll find is there are examples from all over the world, all over different industries, where social entrepreneurs and impact investors have found ways to use Aunnie's own word to hack finance to change the world. So if you're interested in learning more about that particular phrase, you can ask Aunnie about her Coursera class on this. So Aunnie is going to set a landscape for us about what she saw in the research for her book of different approaches. Following her, so following that table setting, we're going to be joined by Caroline Brissan from Open Road Alliance. That is a philanthropic initiative that provides grants and loans that are designed to help social enterprises overcome hurdles or unexpected obstacles. The year 2020 brought us a few obstacles, as you might remember. And Caroline spearheaded an amazing effort to lend $11 million to 30 enterprises in the depths of the COVID crisis. The reason they were positioned to act so quickly, though, is because Open Road has been a philanthropic pioneer in the space of recoverable grants in thinking through using philanthropic capital as impact investing in ways to recycle it. In fact, they provided a very early recoverable grant to Upaya Social Ventures, which she will talk about. And that evolved our own thinking about how we can source our own capital. And I'd be remiss if I did not mention that Upaya is very, very fortunate to have Caroline as a board member. So after going through the broad landscape that Aunnie will provide, and then the specific example of a philanthropic entity and how they're using their capital, I'm going to give a sort of Upaya case study for how one nonprofit organization can deploy this kind of philanthropic impact investing. And then invite Joellen and Nicholson to describe the very innovative approach that University Impact has taken by creating a platform for donor-advised funds and allowing their clients to make an investment just as easily as a grant. For those of you on the call who might have your own funds in a DAF, you know that traditional DAF holders are trying to catch up to these opportunities, but they were not generally designed for impact investing and thinking in terms of returns. And University Impact, on the other hand, has created an experience for their donors which is seamless between philanthropy or investing. It also brings opportunities to the donors that line up with their particular impact objectives in a much more curated experience than is typical. Upaya is incredibly grateful to be a part of this platform, and we'll talk a little bit more about why this partnership matters and what it means for just mainstream donors who want to use their tax-deductible philanthropy in a wider range of activities for impact. So these are our panelists today. And this, as I said, will be the run of our topics. And I want to just pause here and say, we promise that we're going to wrap up with plenty of time to take your questions. We're using the webinar format on Zoom specifically because it has a Q&A feature. And so what I'd like to encourage you to do is throughout the session, put your questions into the Q&A session and or into the Q&A feature. And then as you read other people's questions, please upvote. Typically what we see in these webinars is there will be a lot of questions. Very helpful to know where there is a lot of energy around a particular question. So if you can remember to do that. Also, it is very tempting as you're putting things into chat to put your questions into the chat. Heather will be keeping an eye on that and either gently encouraging you to move your question into Q&A or moving it there yourself. But please try to use the Q&A feature. So without any more ado, I'd like to turn things over to Aunnie to introduce us to the world of philanthropic funding in impact investing.
Thank you so much, Kate. It's lovely to be here and to see you all. I'm going to just speak briefly about venture finance and introduce impact investing. So I think that for those of you that aren't aware, impact investing is investments that are intended to create positive social environmental impact alongside financial return. And philanthropic capital can be incredibly useful in impact investing, and it can be used in a variety of ways, which is what we're going to be talking about today. So Kate, if you'll actually just go to the next slide. What I'd like to do just quickly is talk through, and this one I'm not going to spend much time on because this is not the focus of today, but just to talk through what I go over in the book, which is there's a whole section essentially on philanthropic capital that can be used within impact investing or with the larger world of innovative finance. So the first few chapters actually deal with risk capital, and we are going to talk a little bit potentially about revenue-based financing, which is financing whereby investors can do what is essentially a loan to an organization based off of their historical revenues that is repaid on future revenues. But we're going to be focusing a bit more on grant capital. So if you can actually go to the next slide. So there's a variety of different things that grant capital can do within the world of venture finance or impact investing. So PRIs, program-related investments, are a US-focused, tax code-based investment criteria. So I know we have a distribution across a variety of different countries here, but US-based funders can use program-related investments to be able to make equity investments, make make loans, use guarantees, a variety of the things that are actually in other pieces of the book, and still then be able to essentially use that capital for part of their 5% distribution. So happy to take some more questions about PRIs, but I think it is important to note, one of the things that I found in the research for the book is that US foundations are becoming more and more innovative with how they're using their capital across both their endowment capital as well as their grant capital. And program-related investments essentially give them the option to be able to do things that sit outside of a traditional grant, but that potentially have risk that we would see with more traditional financing tools. And guarantees are one of these. I think that there's a variety of options, as I've said, for grant makers, and one of them that is not commonly used is a guarantee that could be much more commonly used. Essentially, a guarantee is a backing by a large institution or by a set of capital that guarantees the repayment of a portion or the entire amount of a loan, or even necessarily an equity investment. Guarantees are very much like when you may have gotten your first apartment and you had to have a parent or an aunt or an uncle or someone else that already had a job that had a good credit history sign for you, so you were able to get that apartment or for a loan. What guarantees can allow organizations to do is to be able to access capital from banks and other entities, lending entities at lower rates and potentially at a higher, and have more access to that capital based off of this guarantee. And guarantees can be used by grant makers from their balance sheet. So essentially using their balance sheet to guarantee the loan, or they can create separate guarantee funds that can be used. And we can happy to take more questions on that as well. Recoverable grants, which we're going to talk about today, are grants that are made that can be repaid based off of specific milestones, whether it is a grant that is made to an organization that is on lending that money, like Upaya we'll discuss, whereby the lender, if they recover the loan, then repays the donor the amount based off of an agreement. Recoverable grants are an interesting option, particularly for organizations that are looking to build a credit history. So they are flexible capital that can be repaid, and if it is repaid, can be used as a credit history. But if it isn't repaid, doesn't at all cause the organization to go into default. Now, the flip side of recoverable grants are forgivable loans. Forgivable loans are loans that are made that, either based off of social or environmental milestones, are converted into grants or are kept as loans and then are paid off at the end of a period. So recoverable grants and forgivable loans can be very simple, and they can also be relatively complex with the addition of social and environmental metrics. Convertible grants are generally used around R&D, research and development. Convertible grants are grants that can convert into equity at a later stage. And these are used in very, very early stage companies that are trying to build their technology or their product, and then potentially plan to raise additional capital in the future. Now, these are all structures that can be used. There's another lens that we can put on the type of capital that investors, whether they're philanthropic, as in philanthropic capital, or from an investment perspective, or philanthropic capital just from a grant perspective. And this is something called impact-linked financing. So if you can actually go to the next slide. So in addition to structures, so for instance, making a grant that converts into a loan, or a loan that converts into a grant, or doing a pure equity investment, or just a straight debt investment, which are all options for philanthropic funders. There's another option. There's another alternative to making more traditional kind of structures, which is actually linking the contract, within the contract, the impact that you're looking to create to the two different pieces of the contract. So what I've done in the book is I've identified 4 different categories. So you can play around with the cost of capital. This means that you can, for instance, in a loan, you can lower the interest based off of the performance, so based off of the social performance or environmental performance. You can change how much repayment is required. If there's some sort of dividend or profit share, you can play around with that. Essentially, you can change the cost of capital to the underlying organization based off of their social and environmental performance. You can use financial incentives to incentivize them to create additional social and environmental impact. You can also play around with your disbursement. So this means you may have what we call a tranched investment or a grant, and you can actually have impact milestones as opposed to time or financial milestones that can dictate the disbursement of that capital. So this might mean that an organization needs to hit 4,000 women that they're serving with a quality rating of a certain amount by those women before the next round of funding is dispersed, as opposed to it being 6-month based or even financially based. So they've hit X amount in revenue, and you can do them mixed as well. You can also play around with ownership, and this is around equity investing. So you can play around with the amount that employees own, incentivizing founders to be able to earn additional ownership back in the company based off of social and environmental performance, as well as the convertibility. So this is talking about if you're doing a loan that's converting to a grant or a grant that's converting to a loan, you can trigger that conversion based off of impact milestones. So for instance, if you've made a loan to an organization, but they hit a certain number of low-income consumers, which you've been targeting. So let's say you were hoping that the organization would go from 10% of its consumers or its customers to 30% of its customers being classed as low income. You could say once it hit that 30% threshold, then the loan would convert into a grant. And that would create a financial incentive for the organization to do that. So you can go to the next slide. I don't know that I'm going to go through all of these just from a time perspective, but there's also a variety of ways that you can embed your mission into contracts, and I think I'll leave those and maybe have some conversations about them later. But essentially, the idea is that there's a variety of options around things like recoverable grants and even other types of new and interesting types of equity and debt investment that foundations and other types of grant capital can make. And then there's also ways that you can take your the impact that you're looking for and actually link it into the contract itself. So I think one of the things that I'd just like to stress before we continue on with the other speakers is that foundations and other types of philanthropists that are interested in getting into impact investing, you have a variety of ways that you can engage within deals and within funds. And you can specify the type of impact you're looking for with your capital, and you can make that contractual as well. So if you are making grants that are designed within a fund structure, you can make sure that that fund structure is contractually obligated to make sure that that lowers the cost of capital for the underlying organizations, increases accessibility, et cetera. Same thing with guarantees. So I think it's something that I think a lot of philanthropists often are concerned about going into some of these more market rate engagements because they aren't sure that their capital will be used in ways that they really want to see from the impact they're wanting to create. And so there's options for you to be able to make sure that that is actually linked into the contract and actually needs to be created. So I'll stop there and hand over to the next panelist.
Great, thank you, Aunnie. And now we'll have Caroline talk about the open road journey.
Thanks, Kate, and thanks, Aunnie. It's really exciting to see Adventure Finance laying out all of the tools in the toolkit. Open Road has always been instrument agnostic. We just want the right tool to solve the problem at hand and maximize for impact. And we've really just been kind of building the bike while we ride it, as I'll talk about in terms of finding what those right tools are for the problem at hand. I'll give just a quick overview on Open Road. We were founded back in 2012 by philanthropist Lori Michaels, and she really didn't have a sector or geography passion, but saw some things in the philanthropic sector that weren't working as well or as efficiently as it could be for the people that were doing the hard work, which are the nonprofits and social enterprises. So we began to make charitable grants for roadblocks, such as, a change in funder strategy, a government policy change, or a public health crisis that, unexpectedly impaired an organization's ability to continue doing their work. And we were making just charitable grants for a few years, but we realized that sometimes it wasn't that the funding that they had secured wasn't gone. There was just a timing issue. So you need to pay the money to pay your staff to continue programs, et cetera, but the funding had been delayed due to factors outside of the organization's control. So we made our first recoverable grant in 2015, kind of with the idea that the cash wasn't there when they needed it, we could provide it. And then when the cash came in, we would be repaid. We made over 30 recoverable grants between 2015 and 2017, including one to Upaya, which I'll talk about shortly. And, I do want to be transparent that while we're still a big supporter of recoverable grants, we've actually moved away from them since, the goal of our model is really to provide one-time financing quickly to social enterprises in a cash crunch. And so at the time, way back when in 2016, we were trying to do very quick turnarounds. And unfortunately, the DAFs that we worked with, it required a bit of back and forth and often added a few weeks to our disbursement timeline. Obviously, DAFs have come a long way in the last 5 years in terms of familiarity with these different types of instruments. But for us at the time, it was a barrier. So since 2017, we've really been focusing on below market loans instead of recoverable grants out of our own legal entity. And since then, we've dispersed over $40 million in loans, keeping $325 million of impact on track. So, because of the high demand, now we have kind of a separate impact first loan fund where we take in external capital as well. As Kate mentioned, as you can imagine, launching a loan fund for unexpected cash crunches in March of 2020 was well timed to respond to the COVID crisis. And we continue to recycle investor dollars by providing these short-term loans to impact first companies at below market interest rates. Turning to Open Road's recoverable grant with Upaya. Next slide, please. So back to our philosophy of the right tool for the toolbox. In 2015, we designed and made a recoverable grant to Upaya. And the use of funds is really the important thing when you're thinking about structuring a recoverable grant. As Kate will talk about, it will be invested in equity into a social enterprise. In our case, it was a waste management social enterprise in Bangalore. And it was super important to lay out, again, kind of defining rational expectations is one thing that we see as a roadblock between funders and their fundees. There are a lot of potential outcomes of putting equity into a startup, whether it's, all for profit or not. And so we gamed out all of the possible outcomes in writing. As Aunnie mentioned, you can put that in a contract. And so we included things like an expected repayment period, how it would be repaid, scenario planning if Upaya made a partial exit, if they got, you know, a 1-to-1 exit or a profitable exit. And Open Road did cap our return at 5% because the purpose of our funds was not to maximize our financial return, but really maximize our impact return. And then lastly, you know, if Upaya was not able to do any sort of exit before 2023, the recoverable grant would be converted to a charitable grant. And, you know, update on that, Upaya's funds continue to be invested in the company. And to us, that's performing. That's okay. That's meeting expectations. That's why we used a flexible structure like a recoverable grant, because this company currently employs over 2,000 people who we would classify as ultra poor. So the impact is happening, and we still got a little time to see if there's an exit in the future. So that leads me to my last topic. What are the benefits of recoverable grant structure for a nonprofit specifically? And I think they're a really excellent tool. Kate can obviously speak further, but I'll offer just a few reflections. A recoverable grant is the best tool where income may be generated in the future by the use of funds, but the timing and certainty of those funds is not certain. So it gives nonprofits this risk capital that can be invested over a longer period of time, but with much lower stakes than a financial instrument. So like Aunnie mentioned, there's no fear of default here kind of being a scarlet letter on your record. It's also a very flexible tool. So the purpose can be structured as equity-like or debt-like. Even though from a cash perspective, a recoverable grant does act more like a loan, there is a promise to repay given certain conditions. But the really nice thing, and I think the thing that is most helpful, speaking with my nonprofit board member hat on, is that legally it's based in a grant agreement. So the worst thing that can happen, and I say worst thing, is that the recoverable grant agreement becomes a charitable grant agreement. And that's, I think, a lot of, in talking to nonprofits over the years, that's kind of a major source of stress of, oh man, I don't want to be on the hook for this loan and be taken to debtor's court because I can't pay this foundation back. It's also a really straightforward process, because we're setting expectations up front. Conversion to a charitable grant is just a simple status change on the award by whoever is managing your DAF or your back office at the foundation. I will note that from an accounting perspective, and this is a little in the weeds, but nonprofit auditors do recommend showing the recoverable grant as debt on your balance sheet, which again has been known to scare nonprofit boards before, but going back to the legality of it, it's based in a grant agreement. So a recoverable grant can really be great training wheels if you do need to grow through debt financing in the future, and a good toe dip for a nonprofit board to get more comfortable with taking on a debt-like product. And for funders, honestly, it's a great bang for your buck, because although it isn't sure if the funding does come back, then it can be used for charitable purposes or reinvested. So from my perspective, it's a win-win. I think I'll stop there and hand it over to Kate and Joellen to talk about Upaya's current recoverable grant offering.
Great, thank you, Caroline. I mentioned at the beginning that Upaya believes that we can have the greatest impact in our mission, which is creating jobs for the extreme poor, by funding the entrepreneurs who can create those jobs. This is often known as the missing middle, or sometimes the pioneer gap, the companies that are too early or too small to attract traditional investors or even bank financing. But given the right support at the right time, they are often the largest job creators in their communities. So I want to talk about what Open Roads grant did for us and for our thinking about how to more successfully attract capital to be able to fuel this work. So it not only provided, the funding for that one company, which actually is doing remarkably well, and we're really proud of it. It actually kicked off a line of thinking which has dramatically grown our organization. So, like every nonprofit organization, our visions are only constrained by our ability to raise the resources we need to fulfill them. What we found in raising traditional philanthropy for our investments, which is what we were doing, we're raising traditional grants and then investing them, was what every nonprofit will tell you: fundraising's hard. And there's a reason for that. There are currently 1.6 million nonprofit organizations in the United States alone. And I'm quite certain that at least 1.5 million of them are deserving of your donations. So there's a lot of competition for traditional philanthropy. But what's different about Upaya is that, as an investor ourselves, we need capital in a different way than traditional nonprofits need operating funds. If we were a traditional investor, we would just go to other investors and we would raise a fund and we'd make a commitment to return the proceeds from those investments. What the Open Road Grant, recoverable grant, helped us realize is that we could take a step toward that traditional investor approach, while staying a nonprofit organization. So after we received that Open Road Grant, we then secured 2 more recoverable grants to fund 2 more investments. And these grants had the same terms, that we would repay the foundations if the investments returned money to us. And if they did very well, then we would provide a bit of a premium to the foundation. We're capping that premium at 5%. I'm not sure there's anything magical about 5%. We're following the Open Road sort of standard, but also trying to be sensitive to the fact that the IRS is also getting used to these structures and aren't used to seeing grants come back with returns. And so we were trying to pick a number that would satisfy the expectations for how a philanthropic entity should be working. So let me walk you through what this led us to. That was our first step. We had these 3 recoverable grants, but that got us thinking that, a traditional investor would not be going and raising capital for each investment that they make. They'd raise a fund. So what's a nonprofit flavored fund? It's a pool of recoverable grants. We took the idea, that first idea from Open Road, and then we just kind of expanded it to meet our need to be making multiple investments at a time. And so I'll walk you through what that looked like. In 2018, we secured commitments from 6 foundations that they all wanted to be part of this pool. And they all committed at the same time to $1 million of funding that they would pay out like a fund over 5 years. And that as they paid out, we would make investments into companies for our portfolio. Our investment size, by the way, is typically $50,000. So it's about 4 investments every year. As it turned out, one of our foundations actually front-loaded their entire investment of $500,000. So we have been accelerating this, but this was the original thought. So we'd make these investments, and then the piece that's a little harder to predict and to forecast is when we would start seeing returns from our portfolio companies. But we imagine that by year 5 of this project, that we would start seeing exits from these companies. And as we receive the exits, we would send the money back to the foundations. And we followed the same approach. We would take principal, the amount that they had made their grant for, and then cap any return on top of that at 5%. And so we started this we raised the money in 2018, started deploying in 2019. So we're about halfway through the deployment phase of this first pool. And now I'd like to introduce Joellen to come on board, because what we started in a very small way, University Impact is creating an opportunity to do in a much larger way.
Great. So I'm off mute. Great. Hi, everyone. So thank you, Kate. And so I thought I'd kind of take you through a little bit about University Impact. And as Kate mentioned, what we want to do is make it easier for philanthropists to do impact investing into their portfolio of giving through their donor advised fund. And really, when we look at our mission, it's threefold. And we have kind of three aspects that allow us to kind of deliver on our platform and how we built that. So the first is investing in early stage companies, solving social and environmental problems. So that's one kind of core critical piece. And then a second one is setting a standard of doing traditional philanthropy and impact investing better. And finally, creating the next generation of social impact leaders. So when you combine all of these together, as we look at it, it really makes our donor advised fund platform really unique, and it allows us to kind of amplify giving and work with donors to kind of do that. So kind of delving in a little bit deeper, when we look at who we are investing in, so that's those early stage companies I was talking about, we all know that there's persistent problems in the world that need to be solved. And in the emerging markets around the world, there are many organizations with solutions to these problems, but they go unfunded because there's a lack of available financing, which, I think you've heard us all talking about. And that, is typically in this like $50,000 to $500,000 range. And this is the gap that is noted earlier by Kate, is the pioneer gap. So this is where University Impact really focuses our investments in finding and funding these organizations, whether it means domestically or even internationally of where these organizations are. And I think as Caroline was talking about, and even Aunnie, of the types of financing vehicles, our approach is to be flexible as well in our financing vehicles. So we try to meet the organization where they are. So our financing ranges from grants, recoverable grants, and I loved hearing, I think Aunnie was talking about credit guarantees. So we do credit guarantees as well. And then we are doing loans to organizations and even equity investments. So that's looking at, who we are investing in. And then we bring those to donors. And so we look at, how can we look at traditional philanthropy and impacting the impact investing model, and how can we kind of look at that and make it more personalized. When we looked at the traditional kind of donor advised fund model, which was a little bit more passive, requiring the donor who is maybe very busy to kind of, do the research and everything, how could we kind of change that and bring a different model to that and work with the donor to kind of really understand what their preferences are and bring opportunities to them. So we really like to liken ourselves as the donor's kind of family back office, let's say. So we're able to kind of do research on organizations that they could invest in around the world, conduct the due diligence that they need to understand the financials of an organization and companies, and also their impact. What are the outcomes that they're driving towards in the solutions that they're doing within their organizations. And then also, looking at the reporting. How do you report back on, what's happening with the companies that they've invested in? And so we want, really want donors to have that balanced insight into their portfolio of what they're impact investing into, and the drivers that are there. And then lastly, we're creating the next generation of social impact leaders. So what does that mean? So what is really unique to University Impact is that all of our associates are university undergrad and graduate students who search for the organizations that we're going to be investing in. They're conducting the due diligence, they're supporting in portfolio management, and they're engaging with our clients who have their donor advised funds with us. And, our goal here is to give students that real life immersive experience and impact investing that we see will enable them to kind of kickstart their career in social impact, which is kind of needed, we think, around the world. And, we have hubs in the US, in South Africa, and we also have students working for us from the UK, from India, and China. And, we look at this kind of global team really allows us to uncover a lot of these pioneer gap businesses that remain kind of hidden, let's say, because there aren't teams necessarily big enough to find them and do the due diligence on them. But we're able to do that with our team and our structure, and then bring those to the donors that have their DAFs with us, and they can, invest in them. And I like to look at it as when as a case study, looking at what we're doing with Upaya in raising their second pool of recoverable grants, is a great study of how we actually operate. So recently, our UI associates actually did the due diligence on Upaya, on their new fund, and spoke to Kate and the team to kind of do the due diligence on the financials and their social impact and the outcomes that they're trying to achieve with their fund. Wrote the memo. They presented that to our investment committee, who's made up of kind of seasoned professionals in the venture space, the impact investing space, family office, and it passed the investment committee just like it would in any traditional fund. And after gaining approval, that now goes onto the University Impact Platform, and that is available for donors to invest in. But we will present that to donors that we work with, and whose impact preferences it aligns to on who wants to kind of meet, creating jobs for the extreme poor. We'll present that to them as an opportunity to invest in. And then, once that's funded, we actually do the work of working with Upaya on funding that, getting repayments back eventually, and those go back into the client's fund. And then plus that really important piece as well is that reporting back to the donor, which is sometimes missing in donor advised funds now. So reporting back on what their investments are doing. So that's just a little bit about kind of university impact and how we're structured.
Great, thank you. And I'm going to stop sharing and invite all the panelists to come back off video. And while we're doing that, I do just want to put in a plug for university impact from the nonprofit's perspective. When we raised the first pool of recoverable grants, what was really challenging is that we had some donors who were really interested in what we were doing. And they said, oh, that's great. But either they didn't have a donor advised fund, and because this is taking tax deductible money and putting it out there in the world and then having it come back, it has to come back into a philanthropic entity, either a foundation or a donor advised fund. And so if a donor didn't have that, they couldn't participate. And I'm going to jump to one of the questions that I see in the Q&A box already from Margaret. A challenge with the big DAF platforms is the time involved in these investments is often far longer than the DAF platforms or the organizations are set up to handle. And so, you raised the question about if it could take up to 10 years, then your DAF won't handle it. That actually happened with us as well. With one of the big platforms, in fact, the anchor donor in our first pool, his platform said no, or their platform said no, we can't do 10 years. So we had to have sort of a side agreement of, okay, the official contract here, the legal contract here can only go out 5 years because that's what this company is saying, but we have a side contract that says we will renew this. And I can do that because I trust the donor, but obviously that's not a good way to manage that. And so I want to jump in. I'm going to ask a few other questions as well.
Kate,
yes.
Can I jump in there and just yes. add from that perspective, from like a 10-year perspective, and just kind of reading that question as well from Margaret, is that, from our perspective too, like UI allows it. We see it as it's also just a function of the internal rules of the DAF provider. So, however they structure their rules. So that would be something. So if we could say it can go out 10 years, it's more of a function of the rules that the donor advised fund sets versus, a global kind of rule across all donor advised funds, just to kind of set that kind of standard there.
No, that's exactly what I was going to say, because I think that the experience that Margaret's had and the experience that we had are more typical. So can you speak a little bit to, why UI chose to take on this level of complexity? Because we have to admit that if you do have, cash flows going out and then coming back over 10 years, that's a lot harder thing to manage.
Yeah. Well, you know what? I think we see that there's just so much opportunity, just in funding the pioneer gap. And, we don't look at it as a problem. We're like, let's look at these investments. These companies really need it. And when you look at it from the perspectives, this is how we look at it, is kind of like the time value of impact. So you want to solve problems now, right? It's cheaper to solve a problem now versus solving it later. And you also want to think about, I think we were all talking about this before too, is you want to think about the company that you're working with as well. And what are their needs? So then how do you kind of create an ecosystem or a platform that addresses those, knowing that there might be patient capital might be needed, the types of investment, all the different kind of things that kind of go into that, the types of investment vehicles and the terms that are needed. So how can you create something that works within what's needed of the entrepreneurs and the businesses that you're working with, but then also creates, an opportunity for donors to be part of that, who are willing and understand that ecosystem and are willing to kind of work within that structure and aren't confined within that.
Great, thank you. So I want to pose the next question to Aunnie and say that, this notion of impact linked finance was the real aha for me. I think we think a lot, nerds in this space, myself included, think a lot about actual structures and vehicles and such. But I think that what you were describing in terms of, creating better financial terms based on impact milestones is something that anybody from, a traditional individual donor up to a very complicated, sophisticated foundation could be involved with. Can you speak a little bit more about, what is a simple example of that versus what's a very complicated example?
Yeah, perfect. Actually, I'd just like to say, I'd like to highlight there's some great work that have been done on this by a group of researchers that have done a report that I'll throw the link in. They actually did a webinar earlier today and I helped with the report. It's based out of the UK. But so a simple example, UBS has done loans, socially linked loans, whereby, for instance, one to a set of maternity clinics in rural Kenya. And they set a few very simple metrics, which include access and quality of care. And if those are achieved, and if those are achieved, then the cost of the loan goes down. So there's, one cost of the loan, let's use, I don't have the actual number, I can't share the actual numbers for it actually, but let's say the cost of the loan is 8%. And if they achieve the access that they want to be able to achieve around the level of income of women that are coming into the clinics, and if they achieve the quality care, which is pretty simply, calculated based off of a couple of metrics, then the cost of that loan goes down to 4%. So that's very simple, and that was just done just with UBS and the set of maternity clinics, no other organization. And then on the more complex, you have the social impact incentive notes, so the sinks, and you've got the social impact bonds, where there's an outcome payer and there's a lender or a financier and there's an intermediary, and there's a whole lot of different players that are creating incentives to be able to, for instance, in a sink, you'll have a lender that will lend to an organization, and then if the interest rate essentially goes down, or if there's additional outcome payments, those are made by a third party, a donor. So I think what's interesting, I think a lot of grant funders have potentially heard about social impact bonds and sinks and just thought, wow, that just seems really complicated, and they can be really useful, but they also can be quite complex. And so for me, the more that I see them, the more I see that these pretty simple contracts of saying, this is how much something costs, or we're going to give you $500,000 up front, hit these impact milestones, we'll give you another $500,000. That's a pretty simple contract. And you can make it more complex, with these different pieces. But, I think that when donors often shy away from impact investing because they don't see that tangible link between what their capital is doing and actually what the outcome is, whether it's the cost of capital to the end user or to the end consumer, the cost of the products, the accessibility, there's all these different pieces. And so I think that it is, even though some of these contracts can be quite complex, I think we can make them simple, and really be able to see some of that line between why the grant capital is useful, and then also what it's doing and what it's contractually obligated to do.
And Aunnie, just to jump in on that, Open Road actually did our first sync with the Swiss Development Corporation to support entrepreneurs in Latin America. And in terms of the papering, we literally added one clause to our loan agreement, and that's it.
Wow.
So it was already existing, and it just needed one tweak. And then Roots of Impact is doing the impact verification, which is not our expertise.
Excellent. So there you go. So the thing is, even with sinks, they can get, once we get more templated with them, they can get simpler. And so we can, but I do know, for instance, with that sink that you guys did as well, I mean, there's still a lot of bespokeness to it because they are like quite complicated transactions. So we'll get there. But it's nice to be able to know. I think that for a long time, a lot of foundations were told, no, just put first loss capital in, or just, give a grant to this company for R&D because that's what you need to do. And I think that's, understandable, but I also just think there's a lot of ways in which the foundations and donors can say, well, here's the capital, it's really valuable, and here's how it needs to be linked to what we want it to do.
Absolutely. And I think that, any emerging industry, and emerging, it's been, decades, but we're getting more streamlined and understanding the essentials from the very, very complicated structures that existed, say, 10 years ago. So there's a question from Scott, and you sort of touched on it, but I'll ask it just straight on. Could you share an example? And anyone can answer this. I have a feeling Aunnie has the answer. Can you share an example of a milestone that triggers a forgivable loan? And I'd also love to hear you comment on the difference between a forgivable loan and a recoverable grant. Is there a real one?
This was one of the things in the book that I've really tried to make a difference. And to be honest, I mean, there's some accounting stuff as Caroline had mentioned as well. And I've got some of that in the book around some of the different accounting differences. So I do find the one thing I would say is, so Scott, a milestone that can trigger a forgivable loan can be a financial milestone. So for instance, the company doesn't have the cash to be able to repay the loan. And so the donor might just say, well, here, we'll just make it a grant so that it doesn't force you into bankruptcy. That's one option. Or it can be a positive on the other side. So it can be a social impact. So you might say, so the example that I gave when I was talking was, an increase in the percentage of low income users of a product, or it might be a geography thing. So you might say, if you expand out, to this area, or, maybe something around the percentage of users that are rural versus urban. So it can be a variety of different things that you can then cause that loan to become a grant, if you either on the upside or on the downside. But I would say just very quickly on the recoverable versus forgivable. So it is quite useful recoverable grants are very difficult and potentially tax-wise don't make as much sense if it's for a nonprofit that's doing it to a for-profit. Whereas a forgivable loan that sits as a loan can be done from a nonprofit to a for-profit, with the understanding that if it is forgiven, then that amount that is forgiven needs to be counted as taxable revenue for that social enterprise. But my recommendation in the book is that if it's nonprofit to nonprofit, that it should be called a recoverable grant. It should be viewed as one. As Caroline said, there's some accounting stuff in the background, but there's very few situations in which it makes sense to make a recoverable grant from a nonprofit to a for-profit, because when that grant money is received, then it has to be written as taxable income for that social enterprise. And so then if it's repaid, it just triggers all kinds of weird things that I wasn't able to get any clear guidance on. And so I just think it makes the most sense to call it a forgivable loan if it's going to a for-profit. So that's kind of the only real distinction that I can make. The other thing is that, as Caroline said when in our discussions, is that some organizations just feel more comfortable holding it as a grant versus holding it as debt on their balance sheets. And then others actually want to hold the debt to be able to show that they have debt and they're repaying debt. So it can be malleable in that way.
Excellent. There's so much more underneath that than I had ever thought through. That's really great. So I'm mindful that we are at the top of the hour. There's one last question that I think is a quick answer about donor advised funds. Is there something similar outside of the United States? I'm not familiar with any, but do any of our panelists, are you aware?
Go ahead, Aunnie.
No, Joe, go ahead, Julie.
Yes. I thought that the UK and the Netherlands had some sort of structure like them. I don't know if they operate in the same way, but that they had some form of donor advised funds. I'm not sure about anywhere else. Aunnie, do you have anything to add to that?
Yeah, so there are donor advised funds that have been started in multiple different countries, including there was one that was tried in South Africa, and I know a variety of other countries as well. They have not taken off. They're not there's nothing legally stopping them from being created anywhere else in the world. It's just that you need the financial advisors and you obviously need the donors to be able to do that. And then you just need to make sure that so there's, for instance, one of the reasons they're difficult in South Africa is that there's a much higher spend down requirement so the amount you have to spend down is much higher than 5%. Essentially, it's like 30%. So they're trying to encourage people not to essentially hoard philanthropic capital. So it does go against that. That being said, in the UK, Europe, there are trusts that operate somewhat similarly by financial institutions. So they're DAFs by another name.
Mm-hmm.
Thank you. Well, I want to thank all of our panelists and all of our guests for your great questions. I hope we got to all of them. We will be sharing the video. If you'd like to either share it with friends or want to revisit any of this. Thank you very much. Best of luck with your book launch, Aunnie. As I said, I found that yes, I'm a nerd, but I still found it a super entertaining book.
I'm glad.
I am sure it will provide a lot of value to many other people. So thank you all for joining us.
Thanks for having us.
Thank you.
Bye.
Thanks.
Bye, guys.
Thank you.